Welcome to what might be the most comprehensive breakdown you'll see of the 2025 tariff blitz. Over the last 3 episodes, we've been diving deep into this incredible period using AI-assisted research to analyze massive amounts of data, and today we're putting it all together. We're going to tell the complete story from 3 angles: the fundamental news timeline that drove events, the technical signals that warned us what was coming, and the crowd psychology that amplified every move. We're going to show you how these 3 perspectives work together to create one of the most volatile periods in modern market history. If you're serious about understanding markets, you need to see how news, technicals, and psychology interact. So let's dive into 6 months that changed everything. Let's start with the foundation. November 5th, 2024, election night. From a fundamental perspective, the election results removed massive uncertainty about the direction of government policy. Markets had been pricing in election risk for months, and suddenly that uncertainty was gone. But here's where it gets interesting when you look at all 3 angles together. Technically, we saw a classic relief rally gap opening. The S&P jumped higher as election uncertainty evaporated. The VIX dropped from elevated pre-election levels back to around 16, signaling that political fear was leaving the building. Psychologically, this was textbook. Markets hate uncertainty more than they hate clear outcomes, and the moment we had electoral clarity, investors flooded back in. It wasn't euphoria yet, it was relief mixed with cautious optimism. Social media lit up with posts celebrating the end of election anxiety, but smart money was still evaluating what the new policies would actually mean. The consolidation period through January was fascinating because all 3 perspectives aligned. Fundamentally, we were waiting to see campaign promises turn into actual policies. Technically, the market was building energy in a defined range after that initial relief rally. And psychologically, we had 3 camps: policy optimists, policy skeptics, and fence-sitters, all waiting for the real action to begin when governance actually started. February 1st was the moment campaign rhetoric became real policy. 3 executive orders imposing 25% tariffs on Mexico and Canada, 10% on China, all officially designated as security-related measures. Now here's what's fascinating when you analyze this through all 3 lenses. Fundamentally, this was huge. The most significant trade policy shift in decades was actually happening. But technically, the market's reaction was surprisingly muted. We even pushed to new highs over the next couple weeks. Why the disconnect? Psychology explains it perfectly. We were still in the denial phase. Many investors couldn't believe this was really happening. There was still hope that cooler heads would prevail, that this was negotiating tactics, not permanent policy. But if you were watching closely, the cracks were forming. Corporate earnings calls started mentioning supply chain concerns. News headlines began shifting tone. And technically, we were starting to see the early signs of what would become a major breakdown pattern. March was when everything started accelerating. By March 4th, those Canada and Mexico tariffs were fully implemented despite initial delays. Chinese tariff rates jumped to 20%. Then March 12th brought a 25% import tax on all steel and aluminum. This is where the 3 perspectives started screaming the same message. Fundamentally, we were seeing rapid policy escalation that was going to hit corporate earnings hard. Technically, the S&P broke below key support and started forming that classic M-top pattern, one of the most reliable bearish reversal signals you can get. Psychologically, this was when anxiety started accelerating into genuine fear. The smart money, institutional investors with risk management systems started heading for the exits. But retail investors were still largely in denial, buying every dip and posting diamond hands memes on social media. The failed retest of that technical resistance level was telling us that bulls were losing control, even before the major announcement that would change everything. April 2nd, 2025. If you were trading that day, you'll never forget it. The announcement of a minimum 10% universal tariff on all U.S. imports, plus higher tariffs of 11% to 50% on 57 specific countries. This was the most comprehensive trade policy shift in decades. The market's response was immediate and brutal. We gapped down 3% and kept falling, ending the day down 4.84%. But that was just the beginning. Another 5.97% drop the next day. Nearly 11% in 2 days, triggering what would become the worst 2-day loss in U.S. stock market history. Technically, this wasn't just a breakdown, it was a technical apocalypse. The VIX exploded above 50, then hit 60.13, levels we hadn't seen since the darkest days of COVID. When the VIX hits 60, you're in full-blown panic territory. Psychologically, this was the moment fear became full-blown panic. Rational thought went out the window. Social media became an amplifier of despair. Twitter was flooded with crash posts, Reddit was full of loss porn, and even calm financial commentators were using words like catastrophic. The crowd psychology had completely flipped from hope to despair in hours. Those two trading sessions represent one of the purest examples of capitulation in market history. $6.6 trillion in market value gone. The S&P 500 briefly entered bear market territory, falling more than 20% from its February peak. From every angle, this was extreme. Fundamentally, investors were repricing everything based on drastically higher costs and disrupted supply chains. Technically, we had broken through every support level with massive volume, classic capitulation selling. And psychologically, this was the phase where hope dies and is replaced by despair and anger. Think about the collective trauma of that number, $6.6 trillion. Millions of investors watching their retirement accounts, college funds, life savings just evaporate. The news media went into full crisis mode. Trader forums were full of people talking about getting out of everything and never trusting the market again. This is textbook capitulation psychology, the point where even the strongest hands start shaking. But here's what most people missed. Extreme readings like this often mark turning points, not continuation signals. April 7th was psychologically and technically critical, even though most retail traders completely missed it. This was when the overnight E-mini S&P 500 futures showed a failed bearish breakout pattern. Now we're not diving deep into specific chart patterns here, but this failure in the overnight session was absolutely crucial for anyone who knew how to read it. When you see a bearish breakout fail after the kind of selling pressure we'd experienced, that's often your first hint that the bears are running out of ammunition. From a psychological perspective, this was the moment of exhaustion. The sellers had literally run out of steam. Everyone who was going to panic had already panicked. The weak hands were gone. Extreme sentiment readings were off the charts, and historically that's when markets turn. But here's the key, you needed all three perspectives to see this clearly. Fundamentally, nothing had changed, the policies were still terrible for markets. But technically and psychologically, the selling was exhausted. The stage was set for a massive reversal. April 9th gave us one of the most dramatic examples of how news, technicals, and psychology can align for explosive moves. Higher country-specific tariffs briefly took effect, sending markets even lower. Some Chinese goods faced combined rates of 145%. But within hours, the administration announced a 90-day pause on reciprocal tariffs for all countries except China. The market's response was absolutely explosive, a 9.52% surge, one of the largest single-day gains in market history. But here's what made this move so powerful. It wasn't just the fundamental catalyst of the policy pause. The technicals had already set up perfectly with that failed breakdown 2 days earlier, and psychologically, we had maximum pessimism and massive short positions. This was technical analysis and fundamental analysis working together in perfect harmony, amplified by extreme crowd psychology. The same emotional whipsaw that drove markets down now drove them up with equal force. Social media went from despair memes to rocket ship emojis literally overnight. The VIX collapsed from those extreme levels, confirming that the panic phase was truly over. This is why you need to watch all three perspectives. Anyone alone would have missed the magnitude of this setup. Late April was fascinating because it showed how markets heal after trauma. Fundamentally, we had some policy relief with exemptions for certain electronics on April 11th. But retailers were still warning about price increases and product shortages by April 21st. Technically, the market needed time to process that violent reversal. We saw healthy consolidation, not exciting but necessary. Psychologically, this was the disbelief phase. Some investors were afraid to get back in, suffering from crash trauma. Others had FOMO about missing the rebound. The smart money was quietly accumulating, while retail remained largely on the sidelines. News coverage became more balanced, social media sentiment gradually improved, but there was still skepticism. This is normal and healthy. Markets need time to heal psychologically after traumatic events. The three perspectives were slowly aligning for the next major move. May 12th was the day everything came together. The US and China announced a preliminary agreement to reduce bilateral tariffs for 90 days. US tariffs on most Chinese goods dropped to 30%. China lowered theirs to 10% on US imports. From a fundamental perspective, this sparked renewed optimism for comprehensive trade resolution and significantly reduced recession fears. Technically, the S&P 500 surged 3.26% that day. This pushed us decisively above the key resistance level that had been capping the recovery. And psychologically, this was the moment hope officially returned. The collective sigh of relief from millions of investors was palpable. The VIX collapsed from 60 back to 18, normal market conditions. Social media sentiment flipped positive, news coverage became optimistic, and the fear trade was officially over. This completed one of the fastest psychological cycles in market history, from hope to fear to capitulation to recovery in just over 4 months. By mid-May, the S&P 500 had surged more than 13% from its April lows, nearly recovering to pre-crisis levels. This wasn't just luck, it was the natural result of how the three forces we've been tracking aligned perfectly. Fundamentally, we moved from worst-case scenario pricing to cautious optimism about trade resolution. The 10% universal tariff remained as a permanent framework, but the most extreme measures were being negotiated away. Technically, we had completed a classic V-shaped recovery, with all the momentum indicators confirming the new uptrend. The failed breakdown in early April had marked the exact low, validating those technical signals for anyone paying attention. And psychologically, we had gone through complete capitulation, which created massive pent-up buying power. When good news finally arrived, you got both short covering and fresh buying from investors who missed the bottom, a psychological double whammy that created explosive moves higher. What made this recovery so powerful was that all three perspectives aligned. The news got better, the charts confirmed the trend change, and the crowd psychology shifted from despair to hope. The 2025 Tariff Blitz taught us that successful trading during crisis periods requires all three perspectives working together. Let me break down the key lessons. First, fundamental analysis tells you what should happen, but technical analysis shows you what is actually happening in real time. When they diverge, pay attention. It usually means something important is about to shift. Second, crowd psychology amplifies everything. Social media has fundamentally changed how quickly emotions spread through markets, creating more extreme swings in both directions. But the basic human emotions haven't changed. Fear, greed, hope, and despair are eternal. Third, the biggest opportunities come when all three perspectives reach extremes in the same direction. April 7th was perfect, fundamentally terrible, technically oversold, and psychologically capitulated. That's when the smart money stepped in. Fourth, don't fight the trend, but be ready when it changes. The technical signals often laid, the fundamental picture evolves and psychology follows. Understanding this sequence gives you a roadmap for navigating volatility. As of mid-May 2025, we're in a new equilibrium. Active trade negotiations continue with various partners, with the goal of reducing tariffs while maintaining that 10% universal framework as permanent policy. But here's what's really important. The events of early 2025 have given us a new framework for understanding how modern markets respond to policy shocks. We've seen how quickly sentiment can shift, how technical patterns can lead fundamental developments, and how social media amplifies every move. The next time we face a major policy shock, remember the three-lens approach we've outlined today. Watch the news, read the charts, and monitor the crowd. When all three align, that's when the biggest moves happen. The 2025 Tariff Blitz reminded us that successful investing and trading isn't about picking the right story or finding the perfect technical setup or timing crowd psychology perfectly. It's about understanding how all three work together to create market reality. Markets are complex adaptive systems driven by policy decisions, technical momentum, and human emotions. The investors who recognized this, who could synthesize news flow, chart patterns, and sentiment readings, were the ones who navigated this period successfully. The biggest lesson: don't rely on just one perspective. Fundamental analysis might tell you what should happen, technical analysis shows you what is happening, and psychology explains why it's happening. Together, they give you the complete picture. That's a wrap on our comprehensive breakdown of the 2025 tariff splits. If this deep dive analysis was helpful, smash that like button and hit subscribe for more multi-angle market analysis. Drop a comment below with your thoughts on which perspective you found most valuable during this period. Until next time, keep watching those charts, following the news, and reading the crowd. The market never stops teaching, we just need to keep learning.